Welcome back. I want to talk about one of the biggest missed opportunities for retail futures traders. We often hear about how retail traders struggle. I want to explain how they had an opportunity and they basically missed it. So if you go back historically, you go back to sort of the 80s in particular, into the 90s, the retail futures trading started to increase in numbers. Now, to be a retail futures trader in the 1990s, you had to be at home, and the process was quite a long one in terms of it would take a little bit of time and a lot of effort. If you go through the process of making a trade for a retail futures trader, you were sat at home. Most of them were using charts, and we'll probably get to that in a second. They would decide they wanted a trade. They would ring up their broker. Usually they would ring up a broker who was in an office. Okay, that broker in an office would then ring down to to the booth first on the floor. A guy in the booth on the floor would pick up the phone to the guy from the office, take the order, signal it to the pit. Usually there are two people in a pit for a broking firm. One would take the order, one would execute it. So that order would get taken to the first guy. He would tell the second guy, the execution guy, we want to do this. Let's say, buy one up market. The execution guy would go into the pit, execute the order, tell the guy next to him. He would sign back to the guy in the booth that the order had been filled. The guy in the booth would ring the guy in the office. The guy in the office would ring the retail trader. A number of people involved. And because of that, the costs were quite high. I know people that were futures brokers around that time for retail traders, and they could charge 50, 75 sort of US dollars was, I think, quite common as well. And some places were probably charging more. And that was per side as well. So it could take, you could pay $150 a round trip to trade futures. Now that in itself is going to mean that retail futures traders are not going to be able to trade, very short term. They're going to have to take trades of a lot longer in time, and they need to make, obviously, they need the market to move by more to make money. So often, they would need sort of 10 ticks, maybe 15 ticks in some markets to get to break even. So they needed to get these 20, 30, 40 tick moves to make money. And that led them to certain styles, okay? And around that time, particularly from the 80s onwards, some books were being written about how, futures markets were really good for technical analysis. You'll know what they are, I don't need to quote them. Unfortunately, there are some, significant, I wouldn't say errors, but some flaws in the way that those technical analysis books were written. They were sort of back-tested on times where the markets were not as accessible, which basically looked like the performance of the tools were better than they really would have been. But anyway, the retail traders were really driven towards technical analysis at this time. Now, those of us that were around then, if you spoke to any of these retail futures brokers, and I do know some personally, they will tell you that almost all of their clients were losing money trading that way. You're giving up a lot of edge. When you're basically giving up 10 ticks, every time you trade, it's going to be hard. Also, one of those times, you would hear a lot of things when they were struggling to get filled. There would be criticism of the locals on the floor. So these were the market-making people on the floor, guys wearing the red jackets like here. And there's always a lot of criticism. Oh, the locals are doing this. The locals, they just wanted an extra couple of ticks. The locals, were... And there was a lot of criticism of them, and people were angry about the way they traded, but they just traded in a market maker style way. Retail traders and their brokers often would blame them when there was a bad fill. It was the locals. Now, fast forward a little bit to about 1999, London went screen-based. A little bit later for Chicago. Obviously, there is still some floor trading in Chicago, but predominantly screen-based now. And so when the markets changed to being electronic markets, here's an opportunity for retail traders. Opportunities that weren't available before now became available. Now, there's a number of things. Firstly, they had access directly into the market now. Now, before, if you wanted access into the market, you had to go and stand in the pit. Obviously, retail traders didn't want to do that. The costs involved, and they just weren't comfortable in trading in that way. Now, they're able to see exactly the same as everybody else. They can access the market directly on an electronic platform. Commissions came down dramatically. Now, right now, you might be paying $3.50, $4 a round trip for a lot of products. Back then, even in the early 2000s, it'd be a bit more than then, but certainly the $75 a side, $150 a round trip, well, that was basically flying out the window pretty quickly. and commissions came down very, pretty quickly to very low levels. So now here's the opportunity. Retail traders now have an opportunity to trade differently. They're no longer paying that amount of round trip. They no longer need trades that are making 20, 30, 40 ticks and try to do all these, swing trades and technical trades. They can now trade like the pros did. Here's their opportunity. Unfortunately, they didn't grab it. They continue to stay with the technical types of trading, even though we know that they were unprofitable methods before. Now, there are a couple of reasons for that. Number one is retail traders have often just wanted to make big amounts, right? They just see the markets that way. They're often trying to hit home runs. They don't understand the process of compounding or frequency of small profits compounding. Secondly, the educators that had been around and stayed around were not professional traders, didn't understand the ways and the methods of the locals. So we're still pushing technical analysis. And these guys are very good at their sales. So unfortunately, at that moment, in the early 2000s was a real pivotal moment. And there was, essentially, a real opportunity for retail traders, futures traders, and they missed it. They had an open goal and they missed this open goal, unfortunately. And they had their chance to trade more professionally. It was all there for them, but they didn't take them. And again, you can blame the educators and everybody else, but everybody has to take some part of the blame here. What's another interesting development is some of the prop shops that initially were set up to train professional style traders, as the into the 2000s started to go on, realized that retail traders really had no interest in trying to trade like professionals. They had been really sold on this technical analysis idea and swing trading and position trading and holding long trades. So some of the prop shops started to realize that if they wanted to make good money selling courses and educating retail traders, rather than teach them the ways of pros, it was easier for them to teach the methods that the retail traders wanted. So they just pivoted as well to teaching effectively what I'm pretty sure they knew were junk methods, but that was what retail traders wanted. It's why I call it the financial junk food industry, or the trading junk food industry, because there's the question of why do people eat junk food? Because it's convenient. Why do restaurants sell junk food? Because it's what people want. So you're not always going to sell people what's good for them. There's a lot of industries that have grown up to sell people what they want, even if what they want is not particularly good for them. And it happens in our industry. So unfortunately, as the 2000s into the 2010s start to roll on, basically the whole void about education is just completely filled with technical analysis. And like I say, retail traders really missed their opportunity. So in the early 2000s, there was a fantastic opportunity. It's still available now. You can still go that way. But it's very hard to find the true pros out there. So, have a think about what opportunities the market offers, and always think about what's the structure of this market? What role can I play? You don't always have to be the gambler out in these markets. It's how I sort of term it. Most retail traders are acting like punters. They're acting like gamblers. There's a different way to trade the market. You can trade them more like the bookmaker and just try to make small amounts compound it. I've said this before in previous videos. You may not have seen it for some of you that are new, but if you wanted a career, for example, in the gambling industry, right, in let's say horse racing, and you were really like horse betting, if you wanted to be have a sustainable career in that industry, it's going to be as a bookmaker, not as a punter. There's far more successful bookmakers than punters, but the retail guys, most of them want to be punters because they think they're going to get rich quickly. The reality is the vast majority lose. And that profile of what a bookmaker does, make small amounts, just compound, daily, not trying to bet on the outcome of the race, just trying to trade in and out of everybody's money, that doesn't appeal to a lot of retail people in the betting industry, right? It's the same in trading. But if your goal is to make money in the horse racing business, you should better off trying to become a bookmaker and act in that kind of way. The same in trading. So there was a missed opportunity for retail traders, but that opportunity remains around again. So have a think really about why you're trying to trade in the way you are. Why are you trying to achieve these big swings? And is there a better way of doing it?